September 2019. The most boring market on earth suddenly panicked. Overnight rates jumped hard, and the Fed jumped in like a plumber at 3 a.m. because the pipes were making that uh-oh sound. It wasn't stocks. It wasn't crypto. It wasn't some flashy bubble popping on CNBC. It was the overnight cash market that keeps Wall Street breathing. And if you've ever asked, what does the Fed actually do day to day? This is it. This is the basement machinery. The plumbing you never see. By the end of this, you'll understand how a repo hiccup can tighten credit, nudge mortgage rates, and spook markets before most headlines even catch up. So what clogged in 2019? And why did the Fed move so fast? Let's translate repo into plain English. Repo is short for repurchase agreement. It sounds complicated on purpose, but the idea is simple. Cash today, collateral today, swap back tomorrow, plus a little interest. That's it. One party needs cash overnight. The other has cash and wants it to be safe. So they do a collateralized trade, usually backed by U.S. Treasuries, some of the cleanest collateral in the system. If you need a mental picture, repo is like an overnight pawn shop for institutions, except the pawned item is usually a stack of treasuries, not a guitar with a mysterious backstory. Yeah, it's basically the world's least fun pawn shop. No guitars allowed. Why does repo exist at all? Because big financial players don't sit around with idle cash. Dealers don't want to fund huge bond inventories with their own equity. Money market funds don't want their cash sleeping in a checking account. Banks and hedge funds constantly shift cash around as trades settle. Repo is the daily oxygen. Dealers use repo to finance bond inventories. Money funds use repo to park cash safely. The whole machine runs on overnight funding, backed by good collateral. Is coils. And the key word here is collateral. Repo isn't, trust me, bro. Repo is, hold my treasury. So when repo works, it's boring, invisible, silent. When repo breaks, it's like the heartbeat monitor starts beeping. And suddenly, everyone remembers the heart exists. Now here's the thing most people miss. Repo isn't just about the price of cash. It's also a confidence test. When collateral is pristine, Treasury's repo is usually smooth. But repo rates can spike for reasons that sound mundane and end up being dangerous. Sometimes the system doesn't break because assets are bad. It breaks because cash is temporarily scarce in the wrong place, at the wrong time, under the wrong constraints. Think about a city with a full water reservoir. And still, a neighborhood has no water because a valve is stuck. The reservoir looks fine. The pipe is the problem. In money markets, that pipe is often bank reserves and balance sheet capacity. How much room institutions have to intermediate, lend, and absorb flows without choking. And repo is where those pressures show up first. Because repo is where you go when you need funding tonight. So when repo rates jump, it's not just a rate. It's the market saying somebody needs cash badly, and other people are hesitant to lend at normal terms. That hesitation might be about risk, or it might be about capacity. Either way, it's a warning light close to the engine. Now let's talk about 2019, the moment the boring market yelled. Mid-September 2019, overnight repo rates spiked sharply. In a market designed to be calm and collateralized, that's a big deal. Why? Because the Fed tries to keep overnight rates within a target range. It's the foundation for the entire rate structure. If the Fed can't keep overnight funding rates under control, the steering wheel starts wobbling. And once the steering wheel wobbles, everything downstream starts to feel it. Treasury yields, credit spreads, and risk appetite. So what triggered the spike in 2019? A big part of the story is calendar mechanics. Corporate tax payments were coming due, pulling cash out of the banking system. At the same time, Treasury settlement flows were pulling cash out too because people were paying for newly issued treasuries. Two drains at once, and the market discovered something uncomfortable. Reserves weren't as spare as everyone assumed. Not at that moment. Not at that price. So overnight funding demand surged, and the rate jumped. This is the part where the public hears liquidity issues and thinks it's some mystical Wall Street word. But in plumbing terms, it's simple. Too many people turned on the faucet at the same time, and the pipes couldn't deliver pressure. So the Fed stepped in through the New York Fed desk with repo operations. Meaning, the Fed offered to lend cash overnight against high-quality collateral. Treasuries in, cash out. Not because the Fed loves drama, because in plumbing, you don't wait until the whole building floods. You fix the clog when it's still one ugly noise in the basement. And once the Fed became a steady backstop, the market stabilized. The spike cooled. Rates came back down. The beeping stopped. Now, pause right here, because this is the real lesson. Repo asks one question. Is there enough usable cash in the system right now on acceptable terms? In September 2019, the answer was, not at this price. That's what a spike is. It's not a moral judgment. It's a signal. It's the system repricing cash now because cash now suddenly became scarce. Okay, so you might be thinking, cool story. Why should I care? Because repo is upstream from everything. Even if you never trade a bond in your life, you live downstream from bond markets. And bond markets live downstream from repo. Here's the chain. Mortgages often price off Treasury yields. Treasury yields depend on smooth Treasury market functioning. Smooth Treasury markets depend on dealers making markets holding inventory, quoting prices, absorbing flows. Dealers finance that inventory with repo. So repo is part of the invisible infrastructure that keeps the risk-free market liquid. When repo is calm, liquidity is cheap, spreads are tight, and markets breathe. When repo is stressed, everyone gets conservative at the same time. And when everyone gets conservative at the same time, credit tightens. That can mean higher borrowing costs, wider spreads, less appetite to lend, and more sensitivity to bad news. Repo stress is also a warning signal. It's like your engine light. It's not always a crash, but ignoring it is how you end up on the shoulder, Googling, why is my car making that sound while your bank account cries? And here's the bigger takeaway, one that changes how you read headlines. The Fed doesn't just set rates. The Fed runs a system. It manages the plumbing so policy can actually travel through the financial network into the real economy. Because a policy rate on paper doesn't matter if the pipes are clogged. So when you see headlines like market functioning, liquidity support, funding stress, or temporary operations, what they're really saying is the plumbing needed work, and the consequences of plumbing problems can show up where you actually feel it. Your mortgage quote, your credit card APR, your business loan terms, your job market. Let's bring it home with a clean mental model you can keep. Repo is an overnight, collateralized cash swap. Collateral quality matters. Cash distribution and balance sheet capacity matter. Calendar drains can matter. And when repo breaks, it often breaks first, before bigger markets react, because it sits right near the engine. So in 2019, the plumbing clogged, the rates jumped, and the Fed rushed in not to bail out stocks, but to keep the pipes flowing so the whole rate system didn't wobble. That's the point. Repo is boring until it isn't. And when it isn't, it's never just a technical detail. It's a signal that the system is under pressure. If you want the next layer of this story, why Treasuries are the asset behind everything, how yields are set, and why small changes in that market ripple into your life, watch the Treasury bonds video next. And if this helped you see the machinery more clearly, subscribe. Not for hype, not for hot takes, just the mechanics that quietly decide your financial weather.